Hey harvesters, and welcome to the channel. My name is Matt. In today's video, I'm going to be going over the trades I executed for May 29th. I'm going to be talking about the covered calls and the cash secured puts I ran against the SPY and the QQQ. Then we're going to hop over. We're going to take a holistic approach and view how the progress has been in the last 33 trading days. We're going to be looking at weekly data, monthly data, and then yearly data and make a determination. Hey, is this trading actually profitable? Stay tuned to find out. And lastly, then we're going to head over to Robinhood, and then we're going to be discussing ideas and potential buying opportunities for tomorrow. I'm going to teach you guys how to do cash secured puts. I'm going to teach you guys how to do covered calls. So if you're interested in that, stay tuned, like, subscribe, and let's get this started. For anyone that is a new subscriber, the whole point to this channel and this Robinhood account is income generation. There are plenty of YouTubers out there that do the dividend growth investing and the long-term investing. This is not that channel. This is strictly for income generation. Of course, a side effect of the income generation is you want appreciation in your account. And so if that's something that interests you and you want to have creative ideas of how to make an extra side stream of income, this is honestly the safest and most effective way that I have observed to make a income stream without leaving your house. For any of my returning subscribers, you guys know me. The first thing I like to talk about on my channel is my account value. And that's more so a sign of transparency that yes, I am a trader. You're going to see all of my wins, and then you're also going to see all of my losses. I'm very transparent in everything that I do. The account is currently valued at $157,960.43. Let's head over to the spreadsheets and talk about all of the different tactical level movements I made running these covered calls and cash secured puts, choosing strike prices, and some considerations of why I chose specific strike prices. So let's head over there. Let's jump into May 29th. And the key overview of what I did is I ran 2 covered calls on the 200 shares of SPY that I own, and then I ran 2 cash secured puts on the QQQ using collateral. So to run a covered call, you need to own 100 shares of an underlying. 100 shares equates to 1 options contract. So since I have 200 shares of SPY, I can run 2 options contracts. So let me dive into that. So when I bought these shares back a couple of days ago, a couple of weeks ago, I bought the shares at the 593.13 share price. So what that means is for me to not lose money running covered calls, I have to choose strike prices that are at or above $593.13. The way the SPY operates is uses even numbers. So it'd be 593, 594, 595. The lowest number I can choose without me losing any money would be 594. And so for May 29th, the SPY opened at the 593.04. I chose a strike price of the 595, basically being $2 above. The market was kind of hot the last couple of days, so I thought maybe it was going to be neutral to cooling off, and that's kind of what happened today. So I was choosing a strike price that's relatively closer to at the money, and so that netted me about $74, and I chose the same strike price for both of my 200 shares of SPY. So one of them netted me $74 and one of them netted me $77. Because I chose the same strike price, that premium was about the same amount of money. At the end of the trading day, the SPY closed at the 590.05, and then my covered call contracts expired worthless. The way a covered call works is investors going to pay you an upfront premium, and then you're basically agreeing to sell your shares that you own at a specific strike price, and that strike price is whatever you choose. So for today, I happen to choose the 595. So if the market were to go up to 595 or higher, I would have to be obligated to sell my shares to the investor that paid me that upfront premium. But because today I made that upfront premium and the SPY never made it past this 595, I got to keep that upfront premium, and then I got to keep my 100 shares of SPY, and then I get to rinse and repeat this the next day. So I was actually able to keep 200 shares of my SPY. That's kind of the covered calls in a condensed format and a compartmentalized format. Now let's talk about my cash secured puts. So before we talk about what I did, we have to understand what a cash secured put is. Cash secured put is the investor is going to pay you an upfront premium to offload their shares if the market is going to go down. And so what does this mean, and what do you need to bring to the table? The only thing that you need to bring as an investor is collateral, but that collateral has to be able to buy 100 shares of the underlying that you're running a cash secured put on. So for example, I ran a cash secured put on the QQQ. I chose a strike price at the 519 when the QQQ was trading at the 526.31. Basically, the way that a cash secured put works is an investor is going to pay me an upfront premium to offload their shares at a specific price. So I basically agreed to buy this investor's shares at the 519 if it were to go down that low. That investor paid me about $55 so I can reserve the opportunity to buy that investor shares if the market goes down to 519 for QQQ. However, at the end of the trading day, that didn't happen. So I made $55 And the only thing I had to bring to the table was collateral. And I had to bring about $51,900 of collateral. Collateral could either be cash or that could be margin, but you have to be able to buy 100 shares of the underlying because you're agreeing to take that contract. That contract is 100 shares from the investor if the market goes down because they paid you that upfront premium. So that's kind of how it works. And QQQ closed at the 519.93. So I was about 93 cents from getting this contract assigned. So that means I would have to purchase 100 shares from that investor that paid me that $55 premium. So I chose a 519 strike price for one of my cash secured puts, and the next cash secured put I ran on the QQQ, I chose the 517. So the way I run my option strategies, I usually do multiple sets. One set is going to be closer to at the money so I can maximize the amount of premium I'm making. And the other is I'm trying to choose a strike price that's going to help me appreciate my account a little bit. So I kind of have a two-tiered approach or a hybrid approach where I'm trying to lock in a lot of premium with one of my sets of or one of my contracts, and then another set I'm trying to capture some appreciation. But in the case of the QQQ and the cash secured put, I'm actually trying to buy this fund at a better price if the market were to go down so that I can turn it around quicker and then sell it at a better price. And then lastly, I have an IWM weekly call that I ran on Tuesday. It still has not assigned. Unfortunately, I'm trying to offload these shares so I can free up about this $20,000 of capital so that I can use for other things like QQQ investments or SPY investments. But in total today, guys, I made $233 of premium. So that's raw premium, didn't have any appreciation. I'm going to take that every single time. $233 is quite a bit of money for me just doing about 5 to 10 minutes of work in the morning. And here's a view of that $233. I swear I made it. I'm not just lying. All right, back to the main course. With that being said, let's head over to the overview of this project. For the last 33 trading days, we're going to see how much I've made individually throughout this entire 33 days, what it looks like week over week, month over month, and then yearly. I've only been doing this for 33 trading days, so we're not really going to have that full set of data yet, but in about 6-7 months from now, we'll have that data. All right, but let's head over there. We are at the satellite view of the last 33 trading days, so let's get the high points here. When I started this back in April 11th, my account was at $86,312.66. Over the last couple of trading periods until May 20th, I was able to increase this account value by 12.79%. So I went from $86,000 to about $97,000. May 21st, I actually sold a property and got some of the cash from that property and then threw it into this account. So that's why there's a $60,000 gain. It wasn't because I'm a great trader. It's because I just sold real estate and then took that gain from it and put it into my investing account. But then from that point forward, once I add that money, kind of diluted the earnings. Now the new number that I compare all of the gains to is $146,312.66 because I just did what my value started at plus that $60,000 just to keep the math nice and simple. Over the last 33 trading days, this account is up 7.92%, and I've realized $10,127.53. So that's quite a good number if you ask me. I will take that every single 33 days, no problem. Look at the trade win percentage. I'm winning 96.97% of my trades. I had 32 winning days and 1 losing day. The average premium that I make per day is about $306.89. And if we look at the average weekly premium, I'm making about $1,446.79. If we look at that number over a month period, we've been doing this for 2 months. Makes sense that 10,000 divided by 2 is going to be something in the $5,063.77 range. Okay. So in the yellow, I have highlighted some estimates, and these estimates are based off of the actual performance of what my account has been doing this last 33 days. Of course, I'm going to say this might be a little bit optimistic because over the last, month period of 33 days, we're kind of been going in a recovery since the whole tariff talk. But the way I came up with this average yearly premium is I took the amount of weekly premium I'm estimated to make, or I am making, and just multiplying it by 52 because there's 52 weeks in a year. And with that being said, that number turns out to be about $75,233.08. And if we look at that as a average yearly percentage, that's about 51% return. So if you're asking me, I would love to see that, but realistically, I probably would like to make just about $1,000 a week. I think that's more an attainable goal. And when I first started this back in April 11th, I was shooting for a goal of about $29,740. So we're definitely well on our way to meeting that goal. However, if we do come up with a blanket, assessment with the 31 weeks remaining in 2025, if we take this $1,446 and multiply it by the remaining weeks left, we have about 31 weeks. That's about $44,850 I still have to make. So plus add that 10,000, I would have made about $54,000 in a year. That's just a total estimate, guys. That's a number that's made up. I haven't realized it yet, so it means nothing. But a man can dream, and that's why we're doing this. Now let's head over to the weekly tracker. Week over week, I've pretty much been winning every single one of my weeks except for the April 21st, 2025, where I had one bad trade on April 22nd. That made me lose about almost $1,700, but then we won a couple trades and the damage wasn't as bad. Still lost $740, but since then, haven't lost a single day or haven't lost a trading week. And I hope that maintains forever, but that's also me maybe being a little bit naive. But for the current week, we're currently at $981 of profit. We only need about 19 more dollars so I can hit my weekly goal of about $1,000. And I think I can probably do it even with a bad market. So we will see, and hopefully it's up. I don't want it to be bad. I want it to go up. For the monthly tracker for April, I netted about $2,289.53. It was a little bit lower. The premium and appreciation I realized was a little bit lower because I was trying to figure out the strategy, what worked best, how much margin do I want to use, how much margin I don't want to use, how safe do I want to be. Just that entire calculation and risk profile is kind of coming up with the right touch point. And then in May, I'm like, we're going to send it, and then we're sending it. For May, we're at $7,838 of gain. So that is, I'm pretty sure, the median average salary for the United States of America. And the yearly tracker, we already talked about it. We're at $10,127.53. All right, guys, that is the holistic overview of the last 33 trading days. Let me know what you guys think. Is this a strategy that you would be willing to adopt in your portfolios? Just from hindsight, I wish I would have been doing this 10 months ago. When I first started this channel, I first was investing in high income ETFs because I was doing the same thing that everybody else was doing. The premiums were doing really good. You're kind of naive to the NAV erosion aspect because when you're every single week or every single month, you're getting these fat checks. You're like, man, this seems really great. You can never go wrong until the market corrects. And then you're like, wow, I wish I never did that. But hindsight's always 2020. I am super happy I'm doing these safe covered calls and cash secured puts. I'm making a daily consistent income. I'm making almost $1,000 a week, which is the goal. So I couldn't be happier. And if you guys want to adopt this, I highly recommend it. If you just want to be on the sidelines for a bit, go for it, absorb, learn, and then eventually find the confidence, run the options, and you're going to realize, hey, this is actually really easy. Only if you're doing covered calls and cash secured puts and doing it on the right investment. All right, but with that being said, let's head over to Robinhood. Let's talk about what I plan on doing for tomorrow. All right, guys, now that we are back at the Robinhood, let's go to SPY and talk about the covered calls I plan on running for my 200 shares of SPY. Head over to this trade SPY options. You know what I'm going to say here, the money printer button. You press the button, money shows up in your account. All right, now that we're at the options section, see where we're at right now when this buy call. Don't ever do that. 90 to 95% of investors are going to lose money doing this. So I highly recommend just avoid it until you're very familiar just doing the safe trading like the covered calls and the cash secured puts. So to run a covered call, you're going to hit sell call. I plan on running this as a daily option. So I choose an expiration date of 0. So let's take a look at what we are dealing with. So currently the SPY is at 589.72. So it's a little bit lower than what it was yesterday. And so this is definitely going to affect some of our premium that we're going to make tomorrow. But ideally, I bought in the S&P 500, the SPY shares at this 593.13. So for me to not lose money, I'm going to choose a strike price at a minimum of 594 or higher. Some people say you can calculate the premium you made into the cost average so that you can be more aggressive choosing share price. I don't like playing that game because the whole point of me running these options is to realize the gain. If I am calculating the premium into the share price so that I can buy, options at a better rate, that means I'm going to potentially lose out on the income if I get assigned at that lower rate. That means I null out all of the effort I did to make that premium. So therefore, to actually realize the gains, I'm just having a hard and fast rule. It has to be at or above what I paid in for. So at a minimum, we're going to look at this 594. This delta is going to be a 0.24, so it means there's a 24% chance of this executing. Let's see, that $78 is a nice premium. So I'd probably, for tomorrow, I'll probably run one of these at the 594 and one other covered call, because I have two covered calls because I have 200 shares, probably at this 596. If these premiums look the same, let's see what this delta looks like, 14. So yeah. All right, guys, but let's talk about the different scenarios and the negative side effects for running options like this. So let's just use this 594. Investors are going to pay you this upfront premium so that you can lock in selling your shares of the 594 if the S&P 500 appreciates from this 589.62 all the way up to 594 or higher. So there's two scenarios that play out. First scenario is like the most ideal scenario. Investor pays you that $78 of upfront premium. We choose this 594 strike price. The S&P 500, the SPY, never goes up to 594. You keep that upfront premium, and then you also get to keep your shares. You rinse and repeat the next day because we're running dailies. The second scenario that can happen is the SPY shoots up to 594 or higher. So basically, you are required to sell your shares. So the investor pays you the upfront premium of $78. The SPY goes at 594 or higher, and then you're obligated to sell your shares at this 594. So the two benefits you get here are the premium and the appreciation. So you already locked in the $78 of upfront premium because you agreed to sell your shares with that investor at the 594. But if you bought the shares at this 590, you basically would have got this, 590 all the way up to 594 appreciation. So you made $400 plus this $78 of premium. So that's kind of how it works. That's how I run my calculations. But there's two side effects that can happen. You can potentially miss out on gain. So say, for example, same scenario, investor pays you $78. You choose this 594 strike price, but then the market blows past to like 604. Because you locked in your shares at the 594, you basically lost the potential of gaining $1,000 of appreciation when the market shot up like that. So that's one side effect, right? You lose potential gain of appreciation. The other side effect is say that we bought the shares at this 589, right? Theoretically, and then the market shoots down like $10 because this happens too. Because you bought in this 589, the selling premiums at this 580 are going to be significantly lower if you're trying to choose strike prices that are near cost basis. So basically the market went down to 580, but you're still going to be making premium around this number because ideally, if you don't want to lose money, you have to choose strike prices that are at your cost basis. Or you potentially risk getting your shares assigned at a lower level, but if they get assigned, that means you're going to guarantee a loss. Or there are some other things you can do. You can roll options, you can buy the option back, but I usually don't like to do it. I rather just keep things nice and simple. I would rather just the market recover, and then eventually it's going to go back up to paying good premium. Or I say that, but then maybe 1 week, I'd wait a week, I'd wait maybe 2 weeks to see if the market would recover. If it doesn't, then I probably start choosing a more aggressive approach of choosing something below my cost basis, but be ready to roll an option or buy the contract back. So just food for thought. But yeah, guys, for my 200 shares of SPY, I'm going to run two contracts and then probably going to choose this 594, 595, and then the second set, maybe this 597. Really depends on what the premium is, see what the things look like in the pre-market. So we're going to go at that point. And the second thing I'm going to run are two cash secured puts on the QQQ. So let me head over there and then we're going to discuss some of our options. All right, now that we're at QQQ, let's look at the trade QQQ options. To run a cash secured put, you do sell put. I like to run my cash secured puts daily. So we're choosing the expiration of May 30th, which is tomorrow. But by the time this video comes out, probably May 30th. All right, let's see where the spot or the QQQ is trading. QQQ is trading at this $519.50. So the first thing I like to do is I like to look at $3 to $5 away. Some people like to look at deltas. I just look at strike or the actual strike price. So that's going to be, let's start with the 515 and see what the premium looks like. $1.08. I can deal with $1.08 and a 24% chance of this option hitting or getting assigned to me. So let's talk about that. So let's select that as one of the potential things I'm going to run tomorrow. When the market opens, I usually change my strategy, but just to kind of talk about the different scenarios. So the way cash secured put works is the investor is going to give you this $108 of upfront premium for you to lock in buying that investor shares if the market were to go down. So two scenarios that play out here. The QQQ is trading at this 519.60. Investor pays you upfront premium, but then the QQQ does not drop below this 515. The only thing that you need to bring as an investor is about $51,500 worth of collateral. That can be margin, that can be cash, depends on the circumstance. But if the QQQ does not go at 515 or below, you keep that upfront premium. Your collateral gets given back to you at the end of the trading day. You rinse and repeat this the next day and until you get signed, or vice versa, or until you are financially independent. The second thing that can happen is the QQQ does have a negative day. It goes to 515 or below. So basically, an investor pays you upfront premium, and then because the option is going to get assigned to you at the 515, you're buying $51,500 of QQQ shares, which is 100 shares. And then at this point, you can either run covered calls to get rid of them, sell them, do whatever. It's kind of up to your investing strategy. But for me, if I were to get a QQQ shares assigned, I usually run at the money, maximizing premium and then offloading shares because I'm pretty much going to have to use margin to own these shares. That's food for thought. So what are the side effects here? The one big side effect is you choose a strike price for a cash secured put, and then it blows way down, and then you locked in buying shares at the 515, and then say the QQQ is now trading at the 505. So you lost about $1,000 of depreciation of your shares. And on top of that, because if you're going to be choosing strike prices to run covered calls after your shares got assigned to you around your cost basis, the premium you're going to be making is very low because you're so far away from at the money. And like I said, with the covered calls, you can start choosing strike prices that would be closer to this 505, but then you potentially risk getting that contract assigned. And then with that assignment, you're actually realizing that depreciation from 515 to 505. That's just food for thought. That's one of my options contracts. I'll probably choose this 515. Really depends on what the market is doing. Maybe I might be aggressive. I might also choose this 516. I like to offset some of these cash secured puts just like I do my covered calls, just so I can like make some premium, find the best price to buy in at, just things of that nature. But yeah, guys, that's the video. Hopefully you learned something new. Hopefully this enlightens you to open your eyes to maybe a different mechanism to make some income on the side. Matt out. I will see you in the next video.